Hello, everyone. It's really great to have you with us today. A huge thank you for clicking on this video and deciding to spend some of your time with us.
We really appreciate it, and we're going to dig into something pretty important today.
We are. We are opening up the hood on a titan of the pharmaceutical industry, Merck & Co. Specifically, we're breaking down their fourth quarter 2025 sales and earnings call, which just happened on March 2nd.
And honestly, if you follow Big Pharma at all, this is the one call you just can't ignore. Merck is essentially standing on a tightrope right now.
A tightrope. That sounds a little precarious for a company of that size.
It is a very, very expensive tightrope. You have to understand the context here. For the better part of a decade, Merck has basically been the Keytruda company.
Right, the world's best-selling cancer drug. It's been a monster for them.
A life-changing drug, but everyone knows the clock is ticking. They call it the Keytruda cliff. It's that moment the main patent protection ends and, the generics flood in.
Which can just decimate revenue almost overnight.
Exactly. It is the nightmare scenario for any pharma giant. So the whole point of digging into this call is to figure out, is Merck ready for that fall?
And on this call, management seemed to be trying to pivot the whole conversation, right?
Oh, completely. Away from the cliff and toward what they claim is just a staggering number, a $70 billion commercial opportunity in the 2030s.
$70 billion, that is a massive number. So I guess the question is it real? Or is it just, corporate smoke and mirrors to keep investors happy?
That's what we're here to find out. Let's look at the evidence. We should probably start with the Q4 2025 snapshot, just to see how the business is doing right now.
Good idea. Before we get to that 2030 promise, what's the reality on the ground?
Okay, so the headline number for Q4 is steady. Total revenue hit $16.4 billion.
Which is up about 5% year over year.
Right.
5% feels fine. I mean, it's not explosive growth, but for a mature company like Merck, it's stable.
It's respectable. And, no surprise, the engine is still Keytruda. That one drug brought in $8.4 billion.
In just 3 months.
In just 3 months. And sales were up 5%.
It's just mind-boggling that a drug that mature is still growing at that rate. Where's the new growth even coming from?
Well, they highlighted women's cancers, so
Yeah.
breast, cervical, endometrial, and also advanced urothelial cancer. These are areas where Keytruda is just becoming the absolute standard of care.
Okay, so the golden goose is still laying eggs,
Yeah.
but if we're worried about the cliff, we have to talk about what else is on the roster. Did anything else step up?
Yes, and this is really crucial for that life after Keytruda story. Winrevair had a very strong quarter.
Okay, for anyone who's not deep in the cardio space, what exactly is Winrevair?
So Winrevair treats pulmonary arterial hypertension, PAH. It's basically high blood pressure in the arteries of your lungs. It's a really debilitating condition.
And how did it do?
It pulled in $467 million this quarter. That's a really strong trajectory for a newer launch. It suggests doctors are, really adopting it.
What about animal health? That's usually the steady part of the business.
Steady as she goes. Up 6%. A nice, reliable cash flow generator. But we have to talk about the one big red flag in the report.
Which was Gardasil.
Gardasil, the HPV vaccine.
That's usually one of their superstars.
Right. It's been a massive growth driver for years. But this quarter, sales plummeted 35%.
35%. Wow, that's not a stumble. What on earth happened?
It seems to be a geography problem. Management pointed specifically to lower demand in China and Japan.
China. That's a huge market.
It is, and things are getting tougher there for Western companies, so that's a significant headwind to watch.
Okay, so that's the now. A bit of a mixed bag, but solid overall thanks to Keytruda.
But the real story here was the strategic pivot from the CEO, Rob Davis.
Yes, he is laser focused on changing the conversation. He introduced this idea of a line of sight to $70 billion in commercial opportunity by the mid-2030s.
How does that compare to what they've said before?
It is a huge jump. Just a year ago, that number was $20 billion lower.
So they've somehow found an extra $20 billion in future revenue in just 12 months. Found or bought is the key phrase. Mostly bought. They're crediting this to their pipeline transformation, specifically mentioning acquisitions like Verona Pharma and Cidara Therapeutics.
That they're buying their way out of the cliff.
Aggressively. And that buying spree has a cost. You saw it in the earnings guidance, right?
I did. The revenue guidance for 2026 looks fine, $65.5 to $67 billion. But the EPS, the earnings per share, looked low.
It did. It's being weighed down by a massive $9 billion one-time charge for that Cidara acquisition.
Taking the pain now for growth later. Okay, before we get to the analyst grilling, give us the quick rundown on the pipeline highlights from Dr. Dean Li. What are the actual drugs behind this $70 billion promise?
Okay, so 3 areas really stood out. First, cardiology. They have positive phase 3 results for a cholesterol drug called enlicitide.
Crowded market.
Very. But there's always room for something better. Second is infectious disease. They've got a new flu candidate, MK1406, and a really interesting HIV treatment, islatravir.
We'll come back to that one. And the third?
Back to their home turf, oncology. They have new approvals for Keytruda, but they're also really hyping a new asset called sac-TMT. It's an antibody-drug conjugate, an ADC.
We hear ADC all the time now. What's the simple definition?
Think of old-school chemo as a carpet bomb. It kills cancer cells, but it also kills healthy cells, which is why you get so sick.
Right.
An ADC is a guided missile. It attaches that chemo payload to an antibody that hunts for the cancer cell. It delivers the poison right to the tumor.
High precision, less collateral damage.
Got it.
Okay, let's move to the main event, the Q&A session. This is where Wall Street gets to poke holes in the presentation.
And they were definitely in a hole-poking mood. They were not just nodding along this time.
First up was Mohit Benzal from Wells Fargo. He went straight for that new flu asset, MK1406.
Right, and his question was just smart. He noted we're in a brutal flu season. So his logic was, if everyone has the flu, your trial should be getting results way faster than planned.
He was basically asking if we'd get the data early.
Exactly. He asked about an interim look in March.
And what did Dr. Dean Lee say to that?
Well, he confirmed the premise. The flu season is severe. Enrollment is done in the Northern Hemisphere. But he skillfully dodged the early data trap.
How did he do that?
He just emphasized that it's not about speed, it's about the breadth of the data. They need to prove it works in all sorts of different people. Immunocompromised, vaccinated, unvaccinated.
So if they rush the data, they might miss those important subgroups.
Precisely. So no commitment on a March reveal. It's a let us do the science properly answer.
Makes sense. Okay, next was Akash, I think, from Jefferies. He wanted to talk about that guided missile, sac-TMT.
Yeah, this was a strategy question. Competitors like AstraZeneca are moving incredibly fast with their ADCs. Akash basically asked, are you guys being too conservative?
Why aren't you throwing this at every patient you can find?
That was the subtext. But Dean Lee pushed back hard on the word conservative.
He didn't like that.
Not at all. He called sac-TMT a workhorse and a potential best-in-class drug. And then he pointed out they have 16 phase 3 studies running for it right now. 16. That's an enormous bet.
A massive bet. His argument was, we aren't being conservative, we're being precise. We're targeting areas where we think we can be first and best.
Smart. Okay, now we have to get to the question from Alex Hammond at Wolfe Research. This was the big one.
The elephant in the room. The Keytruda patent cliff.
Right. Everyone assumes the party ends in 2028. But Alex pointed out that some SEC filings mention patents that go to 2029. He just asked, how should we model this?
And an extra year of Keytruda is worth, what, nearly $30 billion?
It's not a rounding error, so what was the answer?
Rob Davis, the CEO, took this one. He clarified that the main compound patent does expire in December 2028. That's the hard wall.
Okay.
However, they have other patents, method of use and manufacturing patents, that run until May and November of 2029.
So even if a generic company can make the molecule, they might not be able to sell it for certain cancers until late 2029.
Exactly. It's a legal minefield for them. Rob said their confidence in defending those 2029 dates is growing, but they're telling everyone to plan for 2028 just to be safe.
So what's the real defensive play here?
The subcutaneous version, the under-the-skin injection, they call it QLex. Their goal is to switch 30 to 40% of all Keytruda patients to this new, easier version by 2028.
I see the strategy. The generics can't touch the patients on the new version, which has its own patent protection.
That's it. It's a classic move. Build a moat before the invaders arrive.
Fascinating. Let's switch to HIV. Evan Sigerman from BMO asked about islatravir and this dual regimen. Why is that a big deal?
The standard for HIV right now is a triple cocktail, 3 drugs in 1 pill. Evan asked, why is 2 better than 3?
Seems like a fair question.
It is, and it's all about long-term toxicity. Dean Lee explained that islatravir is a totally new mechanism. It's so potent that you don't need that 3rd drug, which is usually an integrase inhibitor.
And those have side effects.
They do. They're linked to weight gain, metabolic issues. If you can control the virus without that drug class, it's a huge win for the patient.
And there was more to it, right?
Yes, the real game changer. This potency opens the door for a weekly oral pill.
From every day to once a week. That is a massive lifestyle improvement.
Huge. That's how you disrupt a market. You change the patient's entire relationship with their disease.
Speaking of disruption, Steve Scala from TD Cowen tried to disrupt the whole mood of the call with a pretty tough question.
Yeah, this was the roast of Merck moment.
He basically said, look, 2025 growth was minimal, 2026 guidance is minimal. Is this the new normal? Are you just a low-growth company now?
Ouch. But Rob Davis, the CEO, he handled it well. He rejected the premise. He said, don't look at the speedometer, look at the engine.
What does that mean?
He explained that 2026 looks slow because other drugs, like Januvia, are going off patent. That drags down the total average. But if you strip those out and just look at the core ongoing business...
The stuff that will be here in 2030.
Right. That part of the business is growing at 5 to 8%. His argument is, we're shedding old skin, but the animal underneath is growing fast.
A tough sell, but a clear argument. Let's move on. Jane Chen from Deutsche Bank asked about Winrevair in heart failure.
This was a technical question about trial endpoints, what they'll measure to prove the drug works.
And Dean Lee was a bit vague.
He had to be. He said they're still talking with the FDA. It's a rare patient population, so the rules are different. They'll probably measure things like functional activity and clinical events. We can't say for sure until the regulators sign off.
Okay, TBD. Carter Gold from Cantor then asked about immunology and a drug called TL1A.
This is a hot area.
Yeah.
Competitors are moving really fast with combination therapies. Carter asked how quickly Merck would pursue combinations.
And Dean's answer was basically, slow down.
Pretty much. He said first they need to prove their drug works on its own. He teased that they have a big plan for what comes next, but he refused to show his cards on a public call.
Sensible. Jeff Beecham at Citi brought it back to Winrevair, asking about its real-world performance after 2 years on the market.
And this was a victory lap for them. They've had over 110,000 prescriptions. And the key metrics, compliance and discontinuation, are excellent.
Meaning people are taking it as prescribed and not quitting because of side effects.
Exactly.
Yeah.
Better than other drugs in the space. It shows the drug is working in the real world, not just a perfect clinical trial. That's vital.
That's great news for them. Okay, Umar Rafat from Evercore tried a classic trick.
The rumor mill question.
He tried to get Rob Davis to comment on market rumors of a huge acquisition.
And Rob didn't bite. Standard no comment on rumors. But he did clarify their strategy. He said their sweet spot for deals is under $15 billion.
So they prefer smaller, targeted deals.
Generally. But he left the door open for something larger if the science and value were perfect.
Almost there. Chris Shaw from JP Morgan asked about an eye disease drug, MK3000. Why are they so confident in this one?
This is really interesting science. Current drugs basically block a protein called VEGF. It's like putting a bucket under a leaky pipe in the eye.
It contains the problem, but doesn't fix it.
Right. MK3000 is a Wnt agonist. It doesn't just put a bucket under the leak. It tries to repair the pipe. It improves vascular stability.
And there's a real need for that.
A huge need. They said 30 to 40% of patients don't respond well to current drugs. They think this could be a $5 billion opportunity.
Wow. Okay, last question. Dana Graybush asked about using biomarkers for that ADC, SAC-TMT.
Basically asking, will you be selective about which patients get the drug in trials? And Dean's answer was, it depends. If the competition is really tough in a certain cancer, they might use a biomarker to pick the patients most likely to respond.
It's about stacking the deck in your favor to ensure a win.
Exactly.
All right, that was an absolute marathon of information. Let's zoom out. If you're a listener trying to make sense of this, what are the big takeaways?
I think there are three. First, what I'd call the narrative shift. Merck is fighting tooth and nail to prove they are not a one-hit wonder. They want you to stop fearing the 2028 cliff and start believing in the 2035 pipeline.
It's a psychological battle for investors' minds.
It is. Second is diversification. For a decade, Merck was an oncology company. Now, they are seriously planting flags in cardiology, infectious disease, even ophthalmology. They're widening the moat.
And the third takeaway?
Strategic defense. The legal moves around the 2029 patents and that big push to the subcutaneous QLex version of Keytruda, that is brilliant corporate chess. They're buying themselves time.
Buying years of time for that new pipeline to mature and start delivering.
Exactly. They're trying to manage a decline in their biggest product while birthing a whole new company underneath it.
It's one of the toughest challenges in business, the tension between that modest current growth and the massive future promise is just fascinating to watch.
It really is. But if that $70 billion number has any reality to it, They might just pull it off.
And that is where we'll leave it for today. Thank you so much for watching. We really hope this breakdown helped you see through some of the corporate speak and understand what's really going on at Merck.
And if you found this valuable, please, click that like button and subscribe. It really helps us keep making these.
Absolutely. Share this with anyone who needs to get smart on pharma fast. We will see you on the next one.